guys, welcome back to another video. And as always, if you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And as always, if you enjoy the videos, please smash the like button for the YouTube algorithm just so we can reach other people out there as well. And please let me know down in the comments below exactly what it is that you would like for me to cover in my next video. Yes, ladies and gentlemen, this is the only channel that you will find where you have the opportunity to just ask any questions in the comments below and I answer them for you ASAP. Very quick. So let's go out there, spread the word so we can educate as much people as possible out there. Now, if you woke up this morning and you probably had a buy on the Nasdaq 100 and you went, oh my God, what happened with the Nasdaq 100? Well, we're going to dive into that data in a short while. We can see here at the start of the morning, the Dow Jones is down 1.47%, the S&P 500 is down 1.81%, and the Nasdaq is down 2.10%. Now, if you're wondering why stock prices fell so difficult, here's an article from CNBC and it reads, stock futures point to further losses following a steep sell-off spurred by hot inflation. Now, in today's video, we're going to discuss what is fundamental data, what does it do, and how does it work, and how you can utilize it in your trading style as well. But before we continue, the question on everyone's lips is, how does higher interest rates tackle inflation? Or does interest rates always rise with inflation? Yes, it does. Persistently high inflation will move the Federal Reserve to raise the benchmark short-term interest rates, which means they will increase costs for lenders who will pass those costs down onto the borrowers in form of higher interest rate. What that means is that if you purchased a property for 100,000 at a 7% interest rate, just as an example, and the Federal Reserve hikes the interest rates to 8%, that means you will be paying 1% more to your lender for that property, meaning that the the money that you've had has lost its original value that it had, because now you'll be paying back your lender more back in terms of what the initial agreement was. Now the next question was, how does raising interest rates reduce inflation? Well, if it's growing too fast, and we saw that yesterday's PMI data, the US inflation is sky high. It's the highest that it's been, I think, since 1980 in August, and it's never been this high. And the thing is, Powell got asked if they'll just keep pumping money and dumping it into the market. And his answer to that, ladies and gentlemen, was yes, that's what we do. So coming back to the original question, how does raising interest rates reduce inflation? Well, with prices rising faster than wages. So when day-to-day things that you purchase increase in cost, but your wages doesn't keep up with that demand. So think of it in this way. Yesterday, last month, your salary was $1,000. Bread was, let's call it $30. This month, you get a wage increase, which is what we saw last month for the US dollar, but your wage increase, let's say, by 1%. But the price of the bread had, let's say, increased, in terms of inflation, had increased by 2%. So you think that you have, the sufficient capital to sustain your daily lifestyle. Meanwhile, you get to a point where you are unable to actually go out there and purchase goods on a daily basis, because you will have high interest rates, first of all, that you need to pay your bond, your car, whatever it is that you've got on loan. And now you also have food prices that's going up as well. So with prices rising faster than wages, so what does that mean? The prices of foods and services increases at this rate. The wage or your salary increases much slower than that. Now, I think you guys get the concept over here, because at the end of the day, you will never be able to keep up with inflation because your salary is not growing at the same rate as inflation does. So what the government then do is they come in, they raise the interest rates, and this at the end of the day discourages borrowing and it encourages saving, which tend to then slow the economy down and decrease the inflation. So when the government comes in and they hike interest rates, that will open people's eyes to go, you know what, I probably don't want to go out there and make a loan at such a high interest rate because why? I'm rather going to save my money. That means less people are going out there to make debt, and as a result of that, they have to keep paying back all those loans and stuff that they had with the highest interest rate. And as a result of that, the inflation slows down. Now, today, I want to take you guys through, you know, the high impact news that you get out there, what they mean, and how you can trade it. Now, the first one on the line is the unemployment rate, which is something most of you have probably heard about before. Now, one of the key responsibilities of the central bank around the world is to maintain a low unemployment rate. All of the major monetary policy decisions taken by the central bank is to keep it near the non-accelerating inflation rate of employment. Okay, so the idea is for every country's or any country's economy to grow, they obviously want to make sure that they keep the unemployment rate quite low and make sure that there's always jobs available for people out there. Now, all the major economies release an unemployment rate statistic on a monthly basis, and the lower it goes, the better the currency valuation becomes. Partly because when unemployment rates goes down below, which is always near 4%, the central banks start to increase interest rate due to reduce to inflate. They they start to increase interest rates to reduce inflation and cool down the economy. This expectation of higher inflation and higher interest rates is highly correlated with a low unemployment rate. Hence, unemployment rate acts as a leading indicator of future monetary policy decisions as well. Now, if we think about it very quickly, last month the unemployment, the you know the and we'll get to this one over here and what it means. But the ADP came out last month and said that there was a negative, like, there was a job loss of about, I think it was 320K. And then, the NFP came through and the NFP showed there was about 432,000 jobs created. And you can see how the data is starting to be mismatched. And at the end of the day, I think the only people that knows the truth is the Federal Reserve. So they know what's going on, but they don't want to scare investors by giving them the actual figures of what's going on out there. Because the ADP came out and they gave us the data, and then Powell came out and says, no, that's not the case. That's not how it works. Okay, that's not what we do. That's not how we look at things. And unfortunately, next month potentially we could see the NFP being negative in terms of the new jobs that were created. So next line I do want to speak about is the GDP. Now that's the gross domestic product. So it's the growth rate, which is the most important thing from where I'm sitting for any country. Now the GDP is like a scorecard for a game. So if you've ever been in primary school and they gave you that little scorecards, it's just, it's the same thing like that. So it basically just measures the overall health of an economy, and the higher the GDP growth rate, the stronger the currency would be. So let's say, for instance, you're trading the GBP USD, and just by keeping an eye, just by looking at the GDP growth of the US and the UK, you can easily figure out which way the pair would move in the coming weeks. So it's very important to keep your eye on those two, well, not that too, but if you are, let's say, you're a trader that just focuses on trading one specific pair, the most important thing that you do want to look at is the GDP, because that determines the overall growth of the economy in a country as well. The next thing we are going to look at is what's called the CPI. Now, this is my favorite one, which is the consumer price index, because I know a lot of people get confused with this, but that's the CPI. Now, the consumer price index, okay, measures inflation rate in the economy compared to a base year. You do not need to be an economist, guys, if you want to understand how inflation affects given to a set currencies. But just to give you an idea, of how it works would really help you, because most central banks have a monetary policy that tries to limit inflation rate to a certain predefined range. When inflation goes above this range, central banks tries to increase rates to curb down inflation. Now, um, there is a cap. I think it's set at about 50%. Anything above that, or anything below that, is good. But most central banks try to limit inflation rate to 2%, and they use the CPI, the overall CPI data, to measure that. However, the Federal Reserve, the Central Bank of the USA, uses what's known as a PCE, which is the Personal Consumption Expenditure Index, instead of the CPI. So if you're trading the dollar, which most of us do, and you want to anticipate the future interest rate landscape, you can also use the PCE index. Nevertheless, anytime you see a growth, well, anytime you see a forecast of growing CPI, it would be bullish news for the currency. Example, if let's say the forecast for the CPI of UK is 2.5% for a quarter, and the CPI for Australia remains at 1.5, then that will mean the GBP will go up against the AUD, because higher CPI means staggering into inflation, which means interest rate hikes, which means bigger returns for the lenders, which means bigger eyes for investors, because they like to get a higher return on their investors. And who suffers at the end of the day? The consumers, the people that actually buys, and that buys the stuff. So the next thing we are going to speak about is the OIR, which is the overnight interest rates. Now, one thing to keep in mind: bank also borrow money from one another, but they do it in an overnight basis, so when most of you are asleep. And central banks try to influence the overnight rate by lending money in the market at their own overnight rate, and it is an important tool for the monetary policy arsenal. Now, overnight interest rate is the key reason prices fluctuate in the market, as it also affects the swap rate. In many traders think that the main purpose of fundamental analysis is to predict the future rates of the major central banks. Now, I don't know if you've ever kept a trade overnight, and you might see yourself that, let's say you're buying Euro USD, and you see the swap for the Euro USD for that 2 days in particular maybe is 25, well, let's call it $1, but then GBP USD, yeah, the swap there is about, I don't know, $2, but that's because of the interest rate. Sometimes you don't pay anything, because the one country's currency might have a higher interest rate against the other one that you are trading, and sometimes you even get a positive swap, but that's because the currency that you're buying against the other currency has got a higher interest rate against that other one as well. Now, while understanding the monetary policy is difficult, even for myself, the way to interpret the news is rather easy. Let's say if you see a forecast that says Federal Reserve will likely increase the overnight rate, it will likely have a bullish effect on the US dollar. So for example, if the Japanese bank keeps its rates unchanged, it will be a piece of bullish news for the JPY. Now, if you remember the breakdown that I did yesterday, the video for the USD CAD, if you have watched it, you realize I spoke about this, because why the CAD interest rates um, was kept the same last month, and well, yeah, last month, and we're not sure when exactly the Canadian people are going to talk about increasing the interest rates. But because we expect the Feds to hike the interest rates for the US dollar, we can even expect the US dollar to get stronger against the CAD, in the long term, because again, investors invest in currencies that's got high interest rates. Why? Because they want higher returns for their money, so they will keep buying the dollar, because the return that they get for that is a lot higher than investing in the euro, where there is probably, yeah, because I believe that the interest rate is still sitting at zero, if I'm correct. So next we're going to look at the most liked one, the NFP, that most of the gamblers like to trade, where they go, buy stop, sell stop, and then market goes. So the NFP, I think most of you know what the NFP is. So the NFP basically, sorry, is uh, the non-farm payroll figure, and this measures the number of additional jobs added from the previous month corporate in the America, which is an important leading indicator of the overall employment situation. So it's kind of the same thing that we got over here. So the NFP basically tells us how many jobs were created in the previous month. So that's why the data comes out within the first Friday of every month. That gives us an indication of how many people got employed for the previous month, and that also gives us an indication of how well the the dollar is doing. Because, like I said in the first point, when the job creation is quite high, that means it's the economy of the country is doing quite good. And if the NFP is positive, then that's good. But the last NFP we got was so big, and the US dollar just kept consolidating. Why? Because investors were going, whoa, 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 whoa. Something's not right here. How are you going through all of this stuff and you're still creating jobs? And that's why they waited for the CPI data, just to get an indication of what what Mr. Powell has got up his sleeve there once again. Now, the US dollar is the facto reserve currency in the world. Well, one of the biggest currencies in the world, and the non-farm payroll data is usually released on the first Friday of each month by the US Labor Statistics, which is the BLS. Well, there is not an equivalent well, sorry, not well, because there's not an equivalent data release in every economy. You should definitely keep an eye out for the US NFP, as it will eventually have major impact on almost all the currencies involving in the dollar. So if you see there's a forecast for the NFP is higher compared to last month, it is good. And if it's that means that you can buy. So if you are looking for, so if the data is good for the US dollar, then that means you can buy the US dollar, because you expect the US dollar to get stronger against Japanese yen. And I don't know what's wrong with the Japanese yen nowadays, because the price keeps on falling. And then on the other side, if you can sell the Euro USD, because you expect the Euro to get weaker against the USD because of the positive data for the US dollar there as well. Now, I hope you understand how the NFP works. Well, most of you should, because I know most of you trade the NFP as well. Now, next up in line, we've got OPEC. Most of you probably saw that this on like forexfactory.com, because you get OPEC news and all of that stuff, and you think, what is OPEC? Well, today, ladies and gentlemen, OPEC is the organization of the petroleum exporting countries. So OPEC is basically a cartel on an international level. OPEC countries consist of 15 or so. So major crude oil producing nations like Saudi Arabia, the Kuwait, as well as Iran, and the list goes on. Okay, so OPEC controls about 44% of the world's crude oil output. Now, due to this influence, overall prices, OPEC's decisions can move the currency market, because it impacts production on a global scale. As retail traders, you need to keep an eye. You need to keep an eye on what OPEC is doing, especially if you are trading the oil. But if you're not an oil trader, then you don't need to focus as much as this. But also keep in mind that there's a positive correlation between oil and the Canadian dollar. So it could affect the CAD if you are trading the Canadian dollar as well. Okay, so we're there now. So furthermore, low energy prices means more disposable income will be left to consumers, and it can create demand for goods and services, boosting sales. Hence, when OPEC increases their production, now you probably saw most of the time on the news, this says OPEC has increased their production with 400 barrels, and you go, okay, but what does that mean for me? Like, what am I supposed to do with this data? So, excuse me. So when OPEC does increase their production, it tends to increase GDP growth in the US dollar. So when OPEC, next time when you see OPEC, that on the news, OPEC has just increased their production, you're going to expect the dollar to grow or to get stronger, which has a large oil reserve. Okay, there in the US. So, but it may not have a significant impact on Japanese yen, because Japan does not leverage oil reserves. In this scenario, USD JPY would go up, because cutting oil productions will be bullish for the for the US dollar. So when you ever see that again for OPEC, because I know a lot of you see that and you go, um, but oil is not one of the things that I do focus a lot of time trading. I mostly spend a lot of time looking at the order flow and and technical data for oil, because it's quite difficult to analyze the oil, um, because it's what makes it so difficult would be the impact of oil price on a given currency. And but knowing and understanding the impact by reading detailed analysis can help you sense the pulse of the market and make a better trading decision as well. But like I said, I don't focus that much on trading oil, but if I do, I will most likely just go and look at the current price action, because you guys know I do but I spend a lot of time on price action and market structure as well. Next thing we're going to look at is the retail sales. Now, you've probably seen this as well. Now, the retail sales report are usually issued on a monthly basis, and market analysts consider it as a leading microeconomic indicator. When consumers feel safe and secure about their jobs, they tend to spend more on durable and non-durable goods, which boosts transaction and creates value. In terms, retail sales can be a pretty good indicator for future GDP growth as well. Now, the GDP, as we discussed here as well, is the main cunane. Okay, is the like is the GDP is like the brain inside of your head. If people had to take it out, you might not function. Well, that doesn't go for chicken, because if you cut his head off, you will still run around. But okay, you get it. So how retail sales are influencing it can give you an edge in the market, because you can predict GDP growth well before the quarterly reports. So what that means is that if this retail sales are looking good, then you can kind of um, then you can kind of forecast what the GDP is going to look like, because the retail sales gives you a good overview of what the economy is doing, how people are feeling in that country as well. Do they feel good? Do they feel like nothing is threatening their jobs? And you know how it goes, right? When you get paid, the first thing you do is to spend things and go out there and you spend money, because in the back of your head you think that your job is secured and nothing is going to stop you. So you just go out there and and just do whatever you want to, because because in the back of your head you're like, nah, my job is secured, like I don't have to worry about anything, you see. So I am safe in here as well. And then you just go out there and you spend more money, because that's how people do. Like, they work their asses off whole month, and then when they get paid, they just do the same thing that they did the previous month. And then they ask, but like, I don't even see my money, I don't have money. But that's because you spend your money on things that is not important, as opposed to investing it um, for sustainable long-term growth as well. Because at the end of the day, if you think about it logically, most of the things that you buy with your money is liabilities, so it doesn't carry any value. The value depreciates once it leaves the store, like a nice pair of shoes, or fancy car, or whatever the case is. And I got nothing against people with fancy cars, but if you got the money to buy it, then it's fine. But if you're still in that growth process, then it's important to focus your attention on how you can grow your money, as opposed to how fast you can spend your money as well. Now, let's continue. Analyzing retail sales is somewhat tricky, because it also depends on wage growth and overall productivity in the level in the economy. Therefore, before analyzing retail data, you have to keep in mind that while increasing sales can lead to inflation, it can also indicate overconfidence in the economy. After all, if productivity and wages are not growing, but only retail sales go up, it can also indicate that people are buying things to stock necessary items, because they expect a slowdown in the economy as well. But as a rule of thumb, if retail sales does go up of one country, and it is the base currency, but remains stagnant in another, which is the quote currency, it will be a piece of bullish news for the base currency as well. Now, same thing applies. If the retail sales are up for the US dollar, same scenario applies. You can expect that to go up, and the same applies Euro USD, because why? You are buying the dollar against the Japanese yen, and you are selling. You are saying that the euro is going to get weaker against the dollar. Yeah, you're saying that the US dollar is going to get stronger against the Japanese yen. Now, the next thing we are going to speak about, and then we are done, which is the PMI data. Now, if you're not sure what the PMI data is, I've spoken about this many times in the past on my YouTube channel as well. The PMI is the Purchasing Managers Index. Now, the Purchasing Managers Index, you'll normally see that will talk about surveys. So all of this data is purely based off survey results of key purchasing managers in the economy. The survey asks managers, so they go around and ask managers, what is your perspective about your business for the next 6 months? Um, are you planning to hire new people? Are you planning to fire people? Things like that, just to gauge an idea of whether the, of whether job creation is expected in the future or not. The easiest way to interpret the PMI is to keep an eye on if the number is above or below 50. If it is below 50, it indicates that there might be a recession coming. And if it is over 50, then the economy is expected to expand. Now, we know for the US dollar, over the period of time that we've been here, we know that the US dollar, the PMI for the US dollar has always been above 50%, which is good. When we just need to go with that. But I still think that there is something not like they're just not telling us the details. But we can't sit here and say that that's not the data, but we have to go with what they're saying. But we all know that the US economy is just a big bubble that's about to burst in the short term, impacting the long term there as well. So if you are looking to purchase anything that's got to do with interest rates, I would suggest that you don't do anything. Well, that's it. If you live in the USA, then I wouldn't suggest you do. Don't go and take out loans now. Buy properties, buy cars on credit and stuff like that, because you are going to get burned, because that's how things work over here. Now, during the normal growth period, the PMI will normally hover, and you'll see this on the US dollar, but the trick is to see if in the long term how it moves. And what that means is, if the PMI is consecutively going up for the past or for the last few months, and it's bullish for the last few months, um, then what that means is that the news for that associated currency, for example, if the PMI for the UK went from 52 to 55 over the last few months, but the PMI for the US dollar only went from 52 to 53, that means you should buy the Euro USD. Because why? If this is the growth, the PMI growth for the UK, and this is the PMI growth for the US dollar, which is slowly growing, but it's also not there. So what that means is that if the PMI for the euro is higher than the PMI for the US dollar, then you can expect, again, the euro USD to go up. So because you're saying that you're buying the euro against the US dollar, saying that I've done my research, I've put in the work, I've looked at the PMI, I've looked at the UR, GDP, CPI, OIR, I've looked at all of the data, and it indicates that the euro is definitely growing stronger. So I want to buy the euro against the US dollar. And that is basically how the PMI works. So the last thing we are going to look at, which is the most crucial one for the US economy as well, which is basically the housing data. Now, the housing data, if you so there's a thing called the National Association of Home Builders in the US, which oversees the housing sector, and they make up around 15 to 18% of the economy. While the portion of the economy a country's housing sector contributes may vary, it is usually pretty high. I think in China, their housing with the whole Evergrande, I think their housing makes up about 80% of the economy. That's why, and Evergrande being the biggest housing um, part of that, when it collapsed, or when they announced that it was going to collapse, we saw Evergrande fell to, I don't know where it did, because I wasn't following that news, but as a result of that, we also saw the weakness in the Chinese currency as well. Now, while the portion of the economy's country housing sector contributes, like I said, may vary, it is usually pretty high. Hence, as retail traders, you should keep your eye on for vital statistics about the country housing market when you are trading that currency as well. So if you are trading the US dollar, it's important that you just keep your eyes on the housing data as well. Now, just think about it quickly for a second. When you buy a house or start a major over, like if you want to redo your old kitchen again, The answer is when you have a simple savings or expectation. Um, Let me just rephrase that very quickly. If you, or let's say that you're in the market to go and buy a house, or you want to maybe make some changes to your kitchen. The answer is when you have ample savings or expectation of a stable income, right? It's when you have money, when you know that I'm getting paid each and every month. So I want to go out there, I want to buy a house, or I've got the money to go and do whatever I want to. So collectively, when the prices of houses go up or sales of housing units go up, it is common sense to interpret it as a sign of strength in the economy. Also, new housing projects employ a large portion of workforce that can reduce unemployment and prompt central bank to increase the interest rates as well. As a result, when you see a positive housing data, consider it to be major bullish news for the currency. For example, if you see housing starts that counts the number of new housing units being built going down, it can be a signal of a slowdown in the economy. And as traders, we have to interpret that as a bearish move for the US dollar. If you are trading the US JPY, you should then be looking for a sell because you are forecasting the US dollar to weaken against JPY in the short term. Now, that is the most important news factors that you get. Now, I will leave you guys with one piece of information. The fundamental data drives the long-term momentum of the market. Now, when you trade this data, this is what happened yesterday. This is when the PMI came out. Now, I want to show you something that was very frustrated for myself. Okay, although the data for the US dollar was quite positive, we still saw this major drop in the DXY afterwards. Now, you have to understand one thing in the market. Okay, the market needs liquidity. So before any high impact news, what the retail traders normally do is they place a buy stop there, they place a sell stop there, and they normally put their stop losses above that levels because stop losses need to be protected by the structure in the market. So what does the markets do? If there's one thing that you need to understand is that the biggest speculators out there, they can see all your positions, like the retail traders. They know exactly where our positions are. So what the market did yesterday, and you can go look at gold. Well, this affected everything. Gold took a massive drop and then to the upside. Now, keep in mind that fundamental data drives the long-term momentum of the market, the long term. So in the long term, we can expect the US dollar to grow in the long term, okay? Not in the short term. So a lot of people expected this yesterday. It doesn't happen like that. However, so what happened yesterday? We had, people had some buy stops there, stop losses there, sell stops. So the market, and there was a lot of them, aggressive traders coming out there with 10 lots, 20 lots. So what did the market do? The market went, activated that buy stop, came back, stopped everyone out, then went for those stop losses, and then the market, activated those sell stops. The market then went and took that, because if you think about it, all this is where the liquidity was sitting in the market yesterday, right here. This is where all the liquidity was. So the market went to go and get that liquidity. Now from here, we can expect the market to continue higher. Now, ladies and gentlemen, that's all from my side. I hope you guys enjoyed the video, and I hope you've learned something here today. And please, leave a like on the video, like I said, for the YouTube algorithm as well. And as always, cheers for ears.